Question 1. An investor is considering purchasing mutual fund shares and notices that a reduced sales charge is available for larger purchases. This feature is commonly known as A. Right of accumulation. B. Breakpoint. C. Letter of intent. D. Reinvestment privilege. Answer: B. Breakpoint. A breakpoint is a dollar amount at which the sales charge percentage for purchasing mutual fund shares is reduced. This industry practice provides an incentive for investors to make larger investments or commit to doing so over time. For example, a fund might charge a 5% sales load for investments under $25,000, but only 4.5% for investments of $25,000 or more. Always ask clients about other investments they hold that might qualify them for a breakpoint, as it can save them money. Question 2. Which of the following best describes the annuitization phase of a variable annuity? A. The period when the contract owner makes premium payments into the annuity. B. The period when the value of the separate account fluctuates with market performance. C. The period when the insurance company makes regular income payments to the annuitant. D. The period when the death benefit is calculated and paid to beneficiaries. Answer: C. The period when the insurance company makes regular income payments to the annuitant. The annuitization phase, also known as the payout phase, begins when the contract owner elects to receive income payments from the annuity. During this phase, the accumulated value is converted into a stream of periodic payments, which may be fixed or variable depending on the annuity type and payout option selected. Think of annuitization as activating the income stream from the funds you've built up. Question 3. Under FINRA rules, retail communication concerning registered investment companies must generally be approved by whom before use? A. A registered options principal. B. A FINRA examiner. C. A qualified registered principal of the member firm. D. The Securities and Exchange Commission, SEC. Answer: C. A qualified registered principal of the member firm. FINRA rules require that retail communications, which are any written, including electronic, communications distributed or made available to more than 25 retail investors within any 30 calendar day period, be approved by an appropriately qualified registered principal before use. This internal review process is crucial for ensuring that communications are fair, balanced, and not misleading to the public. It's a key compliance step. Before it goes out to many retail clients, a principal needs to sign off. Question 4. According to the Investment Company Act of 1940, which of the following would be considered an affiliated person of an investment company? A. Any shareholder owning more than 1% of the investment company's outstanding shares. B. Any officer, director, or employee of the investment company. C. Any broker-dealer executing portfolio transactions for the investment company. D. Any company that provides custodial services to the investment company. Answer: B. Any officer, director, or employee of the investment company. The Investment Company Act of 1940 defines an affiliated person broadly to include individuals and entities with close ties to the investment company, such as officers, directors, employees, and investment advisors. The Act also includes any person directly or indirectly owning, controlling, or holding with power to vote, 5% or more of the outstanding voting securities of such other person. This definition helps prevent self-dealing and conflicts of interest. Remember, affiliated means closely connected, so insiders like officers and directors always count. Question 5. An investor receives a capital gains distribution from a mutual fund. How is this distribution typically taxed to the investor if held in a taxable account? A. As ordinary income in the year received. B. As a tax-free return of capital. C. As a long-term capital gain, regardless of how long the investor held the fund shares. D. Only when the investor sells their mutual fund shares. Answer: C. As a long-term capital gain, regardless of how long the investor held the fund shares. Capital gains distributions paid by mutual funds to their shareholders are generally taxed as long-term capital gains, irrespective of how long the individual investor has owned the fund shares. This is because the distribution represents the fund's net realized long-term capital gains from selling securities within its portfolio. Even if you bought the fund yesterday and get a capital gains distribution today, it's usually taxed at long-term rates because the fund held the underlying assets for the long term. Question 6. An individual, age 45, is covered by a retirement plan at work. To make a fully tax-deductible contribution to a traditional IRA, their income must A. Be below a certain threshold. B. Exceed a certain threshold. C. Be derived solely from passive sources. D. Be entirely from self-employment. Answer: A. Be below a certain threshold. If an individual is covered by an employer-sponsored retirement plan, like a 401k, their ability to make a tax-deductible contribution to a traditional IRA is phased out based on their modified adjusted gross income, MAGI. If their MAGI is below a specific IRS-defined limit for the year, they can make a full deductible contribution. If it's above another limit, no deduction is allowed, and if it's in between, a partial deduction is possible. The key here is that being covered at work plus having income above certain levels can limit or eliminate the IRA deduction. Question 7. When recommending a mutual fund to a client, a registered representative must make reasonable efforts to obtain which of the following information to ensure suitability? A. The client's educational background and political affiliation. B. The client's investment objectives, financial situation, and risk tolerance. C. The names of other brokerage firms the client uses. D. The client's social security number and date of birth only. Answer: B. The client's investment objectives, financial situation, and risk tolerance. FINRA's suitability rule requires registered representatives to have a reasonable basis to believe that a recommended transaction or investment strategy is suitable for the customer. This determination is based on information obtained through reasonable diligence concerning the customer's investment profile, which includes their age, other investments, financial situation and needs, tax status, investment objectives, investment experience, investment time horizon, liquidity needs, and risk tolerance. Think of it like a doctor needing to know your symptoms before prescribing medicine. Reps need to know the client's financial, symptoms, and goals. Question 8. The expense ratio of a mutual fund typically covers which of the following costs? A. Sales charges or loads paid by the investor. B. Brokerage commissions to buy and sell securities within the fund's portfolio. C. Management fees and operating expenses of the fund. D. Redemption fees charged when an investor sells shares. Answer: C. Management fees and operating expenses of the fund. A mutual fund's expense ratio represents the annual cost of owning the fund, expressed as a percentage of the fund's average net assets. It primarily includes management fees paid to the fund's investment advisor, administrative costs, and other operational expenses like record-keeping, legal, and accounting fees. Sales charges, loads, and brokerage commissions for portfolio transactions are not included in the expense ratio, though brokerage commissions are a fund expense that impacts its performance. Remember, the expense ratio is an ongoing, indirect cost of running the fund. Question 9. Which statement is true regarding the death benefit of a variable life insurance policy? A. It is always a fixed, guaranteed amount. B. It has a guaranteed minimum, but can increase based on the performance of the separate account. C. It fluctuates directly with the performance of the general account of the insurer. D. It is paid out tax-free only if the policy has been in force for at least 10 years. Answer: B. It has a guaranteed minimum, but can increase based on the performance of the separate account. A variable life insurance policy offers a death benefit that includes a guaranteed minimum amount, but the actual death benefit paid can be higher if the investments in the policy's separate account perform well. The cash value also fluctuates with the separate account's performance, but the death benefit itself won't fall below the initial guaranteed face amount. This means there's a safety net for the death benefit, with potential for growth tied to market investments. Question 10. A registered representative recommends and sells a private placement to a client without informing or getting approval from their employing broker-dealer. This activity is known as A. Churning, B. Free riding, C. Selling away, D. Pegging. Answer: C. Selling away. Selling away, also known as private securities transactions, occurs when a registered representative engages in securities transactions outside the scope of their employment with their member firm, without the firm's knowledge and approval. This is a serious violation of FINRA rules because it bypasses the firm's supervisory procedures and due diligence processes. For example, if a rep sells shares in their friend's startup to a client without firm approval, that's selling away. Always remember, reps generally can only sell products approved by their firm. Question 11. When must a prospective investor in a newly issued mutual fund receive a prospectus? A. Within 30 days of purchasing the shares. B. At or before the time of solicitation or purchase. C. Only if they specifically request one. D. After the trade has settled. Answer: B. At or before the time of solicitation or purchase. The Securities Act of 1933 mandates that for new issues of securities, including mutual fund shares, a prospectus must be delivered to prospective investors at or before the time of solicitation, the offer, or the completion of the sale. The prospectus contains detailed information about the fund, its investment objectives, risks, fees, and past performance, allowing investors to make an informed decision. Think of the prospectus as the official owner's manual for the investment, which you need before you buy. Question 12. An investor is considering purchasing mutual fund shares that have a contingent deferred sales charge, CDSC, that declines over several years and converts to another share class after that period. These are typical characteristics of A. Class A shares, B. Class B shares, C. Class C shares, D. No-load shares. Answer: B. Class B shares. Class B mutual fund shares are characterized by a contingent deferred sales charge, CDSC, also known as a back-end load, which investors pay only if they redeem their shares within a specified number of years. The CDSC percentage typically decreases annually and eventually disappears, often after 6 to 8 years, at which point the Class B shares may convert to Class A shares, which have lower ongoing 12b(1) fees. For example, a Class B share might have a 5% CDSC if sold in year 1, 4% in year 2, and so on, until it reaches 0%. Question 13. A variable annuity contract owner has a right to return the contract for a full refund of premiums paid within a certain period after purchase. This is known as the A. Annuitization period, B. Accumulation period, C. Free look period, D. Surrender period. Answer: C. Free look period. The free look period is a provision in insurance and annuity contracts that allows the purchaser a specific number of days, e.g., 10 days or more, depending on state law and contract terms, to examine the contract after delivery. If the owner decides they don't want the contract during this period, they can return it to the insurance company for a full refund of the purchase payments made. This acts as a consumer protection feature, giving folks a chance to change their mind after seeing all the details. Question 14. The Investment Company Act of 1940 requires that a majority of a registered investment company's board of directors must be A. Affiliated persons of the investment company, B. Employed by the fund's investment advisor, C. Independent or disinterested persons, D. Certified Financial Planners, CFPs. Answer, C. Independent or disinterested persons. To protect shareholder interests and provide objective oversight, the Investment Company Act of 1940 mandates that a certain percentage of an investment company's board of directors must be independent, meaning they are not affiliated with the fund's investment advisor, principal underwriter, or other interested parties. Currently, the rule generally requires that at least 40% of the directors be independent, but if the fund has a 12b-1 plan, a majority of the directors must be independent, and a majority of the independent directors must approve the plan. The key is that independent directors are there to look out for the shareholders without conflicts of interest. Question 15. An investor purchases 100 shares of a mutual fund at a net asset value, NAV, of $10 per share and pays a total sales charge of $50. Later, the investor reinvests $200 in dividends to purchase additional shares. What is the investor's total cost basis for these shares? A. $1,000. B. $1,050. C. $1,200. D. $1,250. Answer, D. $1,250. The cost basis of mutual fund shares includes the total amount paid for the shares, including any sales charges, plus the value of any reinvested distributions, like dividends or capital gains. In this case, the initial purchase cost $1,000, 100 shares x $10 NAV, plus a $50 sales charge, totaling $1,050. The reinvested dividends of $200 also add to the basis. Therefore, the total cost basis is $1,050 plus $200 equals $1,250. Remember to add in all costs and reinvestments when figuring out your starting point for tax purposes. Question 16. An individual, age 50, takes a distribution from their traditional IRA. Assuming no exceptions apply, this distribution will generally be subject to A. Ordinary income tax only. B. A 10% penalty tax only. C. Ordinary income tax and a 10% penalty tax. D. Capital gains tax and a 10% penalty tax. Answer, C. Ordinary income tax and a 10% penalty tax. Distributions from a traditional IRA are generally taxed as ordinary income in the year they are received. If the individual is under age 59.5 and takes a distribution, it is typically also subject to a 10% early withdrawal penalty tax, unless a specific exception, such as death, disability, or first-time home purchase, applies. Since the individual is 50, which is under 59.5, both ordinary income tax and the 10% penalty would usually apply. Think of 59.5 as the magic age for penalty-free IRA withdrawals. Question 17. A customer wishes to open an account where, upon their death, the assets in the account will pass directly to a named beneficiary, bypassing probate. Which type of account registration would achieve this? A. Joint tenants with rights of survivorship, JTWROS. B. Tenants in common, TIC. C. Individual account with transfer on death, TOD, designation. D. Custodial account under UTMA. Answer, C. Individual account with transfer on death, TOD, designation. A transfer on death, TOD, designation allows the account owner to name one or more beneficiaries who will inherit the assets in the account directly upon the owner's death, avoiding the often lengthy and costly probate process. While JTWROS also bypasses probate, it's a form of joint ownership, not solely for an individual naming a beneficiary. TOD is specifically designed for individual accounts to transfer assets seamlessly to beneficiaries. Question 18. An investor currently owns $15,000 worth of ABC Mutual Fund shares. They plan to invest an additional $10,000. The fund offers reduced sales charges at the $25,000 investment level. The investor can qualify for the lower sales charge on the new $10,000 investment by utilizing A. A letter of intent. B. Rights of accumulation. C. An exchange privilege. D. Dollar cost averaging. Answer: B. Rights of accumulation. Rights of accumulation allow investors to count the current market value of their existing holdings in a fund family, along with any new purchases, towards achieving a breakpoint for a reduced sales charge on the new money being invested. Since the investor already has $15,000 and is adding $10,000, their total holding will be $25,000, qualifying them for the breakpoint on the new $10,000 purchase. It's like a loyalty program where your past investments help you save on current ones. Question 19. In a variable annuity, the separate account is used to A. Hold the insurance company's general assets. B. Invest the annuitant's premiums in fixed income securities only. C. Invest the annuitant's premiums in a variety of subaccounts with different investment objectives. D. Guarantee a minimum rate of return on the premiums paid. Answer: C. Invest the annuitant's premiums in a variety of subaccounts with different investment objectives. The separate account of a variable annuity holds the premiums paid by contract owners and invests them in various subaccounts, which are essentially mutual fund-like investment portfolios with different objectives, e.g., equity growth, bonds, money market. The performance of these subaccounts determines the annuity's accumulation value and, potentially, the amount of income payments during annuitization. Unlike the insurer's general account, which backs fixed annuities, the separate account's value fluctuates with market performance, and the contract owner bears the investment risk. Question 20. Under FINRA rules, when a registered representative receives a written customer complaint, they should typically A. Attempt to resolve it directly with the customer immediately. B. Forward it to their supervising principal or compliance department. C. Disregard it if they believe it is without merit. D. Send a copy to FINRA within 24 hours. Answer: B. Forward it to their supervising principal or compliance department. FINRA rules require member firms to have procedures for handling customer complaints, and these typically involve escalating any written complaint to a supervisor or the compliance department for review, investigation, and response. Registered representatives should not attempt to resolve complaints independently, as this could lead to inconsistent handling or failure to meet regulatory reporting obligations. Promptly forwarding complaints ensures they are addressed according to firm policy and regulatory requirements. Question 21. If a diversified open-end investment company wishes to change its fundamental investment objective, e.g., from growth to income, it must obtain approval from A. FINRA. B. Its board of directors only. C. A majority of its outstanding voting shares. D. The Securities and Exchange Commission, SEC. Answer: C. A majority of its outstanding voting shares. An investment company's fundamental investment objective, as stated in its prospectus, can only be changed with the approval of a majority of its outstanding voting shares. This is a significant protection for investors, ensuring that the basic nature and purpose of their investment cannot be altered without their consent. While the board of directors oversees the fund, such a fundamental change requires a shareholder vote. Think of it like shareholders getting a say if the company decides to completely change its core business. Question 22. Withdrawals from a non-qualified variable annuity during the accumulation phase are generally taxed on what basis? A. First in, first out, FIFO, with earnings taxed last. B. Last in, first out, LIFO, with earnings taxed first. C. Pro rata, with each withdrawal consisting of a partial return of principal and partial earnings. D. Tax-free until the principal amount has been fully recovered. Answer: B. Last in, first out, LIFO, with earnings taxed first. For non-qualified annuities, those funded with after-tax dollars. Withdrawals during the accumulation phase are taxed on a last-in, first-out, LIFO, basis. This means that any tax-deferred earnings are considered to be withdrawn first and are subject to ordinary income tax. Once all earnings have been withdrawn, subsequent withdrawals are treated as a tax-free return of principal. This LIFO treatment means the taxable portion comes out before your non-taxable contributions. Question 23. Which of the following is a characteristic of a no-load mutual fund? A. It is always sold with a 12b(1) fee exceeding 0.25% of average net assets. B. It can be purchased or redeemed without any sales charge. C. It primarily invests in U.S. Treasury securities. D. Its shares are traded on a stock exchange. Answer: B. It can be purchased or redeemed without any sales charge. A no-load mutual fund is one that does not impose a sales charge, load, when investors buy or sell shares. Investors purchase shares at the net asset value, NAV, and redeem them at NAV. While some no-load funds may have 12b(1) fees, used for marketing and distribution expenses, for a fund to call itself no-load, this fee cannot exceed 0.25% of the fund's average net assets per year. The key is no sales charge upfront or on redemption. Question 24. A husband and wife open an account where, if one owner dies, the surviving owner automatically inherits the entire account. This type of account registration is known as A. Tenants in common, TIC. B. Joint tenants with rights of survivorship, JTWROS. C. Custodial account. D. Partnership account. Answer: B. Joint tenants with rights of survivorship, JTWROS. Joint tenants with rights of survivorship, JTWROS, is a form of account ownership, typically used by married couples, where all owners have an equal, undivided interest in the account. Upon the death of one owner, their share of the account automatically passes directly to the surviving owners, bypassing probate. This right of survivorship is the distinguishing feature. For example, if a husband and wife have a JTWROS account and one passes away, the other becomes the sole owner of all assets in that account. Question 25. A registered representative frequently buys and sells securities in a customer's discretionary account, primarily to generate commissions rather than to benefit the customer. This prohibited practice is known as A. Front-running. B. Marking the close. C. Churning. D. Free-riding. Answer: C. Churning. Churning is the excessive trading in a customer's account by a registered representative for the primary purpose of generating commissions, with disregard for the customer's investment objectives and financial situation. It is a serious ethical violation and a fraudulent practice. The key elements are the frequency and nature of the trading being unsuitable for the customer and motivated by the representative's desire for commissions. Think of it as over-stirring the account just to make money for the rep.